Loud and clear. Yes. Hi. Hi. Okay. Yes. You guys are a scam. Okay. Yes. Yup. Yes. Yes. Your market model sucks. Great. Morning. Okay. Those are nice responses. Thank you. Well, here we are. Today it's Friday, February the 4th. Market's been a little bit funky. You can see my screen going here. We got the Dow coming off a little bit here on the jobs number. And I wanted to welcome you to what we're calling the Gil Report, which are our online webinars, which for now are free, and they're featuring Dr. K's laboratory. Basically, get rid of that. I'm taking the name from a piece I used to do back when I was a stockbroker, which I called the Gil Report. I used to put this out every weekend. And my clients loved it, and people would actually open accounts up with me when I was at Payne Weber. You can see down here we have some notes from Payne Weber. This report is actually from May 5th, 1995. I'd have some market comments, and I'd run through ideas that I saw in the market. And that's basically the idea behind these webinars. The added upside here is that we're going to be including Dr. K as our perpetual guest, who I'd like to introduce now. Dr. K, are you there? Are you awake?
I'm here. Yeah. How you doing?
I'm doing well. So I'm sure it's afternoon in London there. It's 8 o'clock here on the Pacific coast, or the California coast where I'm at. And we're going to go through the market here and some of our ideas right now. One of the things I think that's interesting about this report from May 5th, 1995, some of you who read our book, Trade Like an O'Neill Disciple, will recall my discussion about C-Cube Microsystems, which is really the first stock that I ever made huge money in. I was up 520-something% that year. It was an insane move, and you can see this is actually the first weekend that I come across the stock in my work. Back then I used to flip through the old Daily Graphs books. I think they still sell them, and I used to generate my ideas from there. People would open accounts with me at Payne Weber just to get this, but what would happen is that they would open a $10,000 account with me while they're trading their $200,000 over at a discount broker. If I found out about that, generally I would get rid of them. In any case, it's interesting just to read my comments about C-Cube back then and things going on with the internet. It's just somewhat interesting, somewhat funny to me in that it really is dated because we've come a long way since then. There's so many new opportunities in the market with respect to what is really a new paradigm in how we do business. And of course, this webinar is certainly part of that. We're using technology that allows us to reach up to 500 people, which we sell out pretty quickly on these webinars. Well, we actually don't sell out because we don't sell them. But in any case, let's look at our market today. Again, I'd like to thank Bloomberg for letting us use their charts. Let's see. Did I get this right? I'm still not doing that right. Let's see. You have to forgive me, I'm a little bit slow with this. No. Yeah, that's what I'm looking for. I may have to scrap this and go somewhere else. I'm not sure why it's not coming up, but let's try this. That may not work. All right, let's do this. I'll just use this chart here. Okay. Here's the NASDAQ today. We're actually just down a hair. You can see we broke a couple of times last week, found support. This was logical support. My thinking was it was logical to see a rally given the fact that last Friday's sell-off was supposedly caused by news in Egypt And one thing I would say about news is, yes, news can create a sell-off that is a buying opportunity, but not always the case. I think in a lot of instances, you really just have to go with the price volume action. What you'll find out is later on you may see the indexes show the true action. In the meantime, things could be alibied. So we know that we did get follow-through type action where the index, NASDAQ was up. Dr. K, how much was the NASDAQ up on Tuesday?
Tuesday up 1.89%.
Yeah, so you use 1.5% for a buy signal, so that generates a buy signal.
Actually, no, that's I've recently changed that to those threshold numbers have changed because the market has stayed consistently at a lower volatility level for at least 3 months. So right now, here, I'm going to go to my spreadsheet because I want to get the exact numbers that I calculated last.
Okay, but in any case, you had this follow-through type signal. So now, but see, to me, this is an orphan follow-through. There's no real downtrend here. The market's just going sideways, and then you get this follow-through type action. Is it the end of a downtrend? Is it telling you we're starting a new upside trend? No, I just think it's constructive action, but you also don't know whether this move was caused by early shorts coming in on these. And in fact, one thing that I don't like, and Dr. K, you can feel free to argue this point with me if you like, is the fact that the volume on the downside on these bigger breaks here, here, and here is not as heavy as it was on the upside. So I'm wondering, is this just short covering from the early, as I like to call them, piggy shorts, or is this in fact creating a new rally and we're going to break out? What I notice here is you run into some resistance, and the market feels a little fuzzy to me. So my stance essentially is to not be very aggressive. We can take a look at say the S&P here, for example. And the S&P, similar sort of situation, heavier volume here is not exceeded here. You did trade some heavy volume here, but notice how you sort of churned and you closed at the lows. So a little bit of, there's some sort of churning weird action here, but you're in an uptrend, you're holding tight in here, you could resolve to the upside and continue higher. Now the question there becomes playing the market less as a stock market and more as a market of stocks. And so what we do is we focus on individual stocks rather than the market itself. So, and as you've been seeing, the timing model, Dr. K's model, has had some false signals. And I think it's very interesting that you can explain it till you're blue in the face. And if you go on their website, selfishinvesting.com, Dr. K does a pretty thorough explanation of the historical results of the model. And it does show that there are periods where you'll get whipsawed with a few false signals going both ways. That's what the model does. That's, in some environments, that's normal. And I find it interesting that people will email us with a lot of emotion and they're upset and calling us a scam and frauds and all this. And it's such baloney, but it tells you that people react emotionally to the market in sometimes irrational ways. And you can show them a model that does have periods where it gets whipsawed around on its signals, but then when that actually happens, people want to freak out about it. It reminds me a lot of when I was running a hedge fund. And I could show people my 8-year track record where I made close to 11,000%, and I'd show them, you know, there are periods here where I drew down 30, 40, 50%, even I think at one point 80%. And you ask the people, well, if we draw down 20%, how do you feel about that? Oh, I'm okay with that. And that's because they're greedy and they can only think of the upside without ever considering the downside or the fact that sometimes things don't really work out. So when you drop 20 or 30% one time, oh my God, that's the end of the world and you're a fraud and a scam, even though you can show in your track record, just as you can show with the market direction model, that it has periods where it has some trouble. Now, we got a great signal back on September 1st, and that was a profitable signal if you played it right. So it did work out pretty well back then. But I think it's interesting that people, and I have to say, to be fair, that we only get, you know, less than a handful of these types of emails. But to me, it's a little bit irritating simply because I think it's unfair and it's unrealistic. It's almost ludicrous what people will do when they start getting upset and emotional. I think you really have to avoid that in your trading. It's just not constructive. So we can see what the market's doing, and I'm going to go through some of the stocks that we have on our portfolio simulator. Now, the portfolio simulator, to me, if you're going to be long this market, the portfolio simulator right now seems to me to be the best approach. a very slow, steady, measured approach. You take your positions. You know, we take very, very slow positions, 12.5%. We're going to divide our portfolio into 4 names. 25% is going to go into each stock in the portfolio initially. So we're going to start with half positions at 12.5%. Right now, we have a 12.5% position in Netflix. Our entry there was 213.88. Okay, and you can go back to our reports on that. Now Netflix here is breaking to a new high. There's nothing wrong here. This is a viable gap up. The low here is about 204 and change, somewhere in here. 204.53 is what it seems to be showing here. You never violated that low, and now you're pushing to new highs. I think it's interesting that today we find that Netflix is looking at raising their prices. You know, for so long we've heard from these short sellers who seem to have a ready soapbox to get up on to voice their opinions. That Netflix is going to have to pay more for content and their margins are going to fall. You know, for $9 or whatever it is they charge for streaming movies, that's pretty cheap, and I think people would pay up to twice as much, and that's one way that they'll compensate for the higher cost of content. And I think that's just a ready-made strategy for them. And I think if you're short the stock, you're an idiot. You're an absolute idiot, because the price volume action is telling you that this thing wants to go higher. Now, this is something else I would point out. In bear markets, even when you top and you start a bear phase, and you can go back to October of 2007, the solar stocks continued higher even though the market topped in October. And so you can see leading stocks continue higher even if the market acts poorly. So we like Netflix here, and we think taking a 12.5% position at 213.88 on the basis of the gap up, using the low there as your stop, makes perfect sense. Okay, and of course that's being proven out today. Even with the indexes a little bit sloppy and weak today, we're seeing that happen. You have to excuse me, I had to go close the door there because we have a cockatiel down the stairs here, and the cockatiel loves to talk, and so you'll hear him chatter. Hybrid brain, get a job, things like that. That'll come in handy when my kids are teenagers. Anyways, so we like the Netflix there. Now, if we look at CMI is another one that we liked. Okay, now we bought this one at 107. We took a 12.5% position. The next day, you know, this is a pocket pivot. You've got pocket pivot volume here. Earnings came out. The stock dropped. It undercut this low here, and then holds the 50-day here, just above 107 there. The next day it closes just below. So what we do, we don't like this, and we came in and added another 6.25. Now, a lot of times I'll add to a position if I think it should start to move. And just real quick, I want to show you, this is what I was thinking on this, that ACI, which had done the similar sort of thing on earnings, broke down and then actually got a pocket pivot back above the 50-day, that it would gap and start to move. Now here it's pulling back, and this might become viable in here as it pulls back, but my whole mode of thinking here on CMI was that you would get a similar sort of thing. Now this is a little bit slower, but I think it looks constructive, and of course it's moving higher. It doesn't have to launch, but I think this stock, which qualifies as sort of a stuff stock, they make engines. In fact, when I was at Stanford, a spring quarter of my senior year, I actually went out to Columbus, Indiana, which is a pretty little town where CMI, Cummins Engine, is based. And very, very good company. I wanted to get into marketing at the time. I ended up taking a job with Caterpillar, which I never showed up for, but that's another story. In any case, I think this stock is trying to go higher, so we like this stock, okay? The other one we picked, obviously, was Baidu, okay? And the same basis as Netflix. You have a viable gap up here. Your low is with 115.10, as I count it, and you're going straight sideways here. So my guess is that if the market doesn't break down, this should go higher, okay? And I would look for it in the next few days to push through 120. We have an 18.75% position, so 3/4 of a full position of 25%. And we bought it at 117 on the first 12.5%, and then at 118, I think 90 on the second piece, 6.25%. So this is doing fine too. And what we're going to do is we come in here, we're about 30, almost 50% invested, 44% invested roughly. So we're less than half invested right now. We're letting this just kind of work its way around. I think at this market, the indexes are volatile intraday. You just want to take measured positions, have your stops in mind, and just be very steady. Now the other one, this is always controversial because people can't believe you buy a stock extended. But you know, sometimes I buy stocks extended, and I would point to an example of Apple Computer back in 2004 in October. The buy point was, I don't know, somewhere in the mid-30s, and I was buying the stock 350,000 shares, adding to my original 50,000 shares at about 42, 43. When I think something might start moving, I will tend to move into it, and I'm not shy about losing it. In other words, selling it if I don't think it works out. You know, a lot of people can't really get that one into their heads. But look, when I bought FTNT yesterday, I didn't notice a marriage ceremony anywhere, so I don't think I was obligated to hold the stock if it doesn't work out, or I'm obligated here. But what I like here is, okay, when we first bought this, we took the position somewhere, I think around 37.90, I believe it was, coming in here, and on this pullback. And then what happened is it did what I thought it would do. It pulled back to the pink line here, the 10-day moving average, and it held. And you had some volume pickup right here, right off the 10-day moving average, and that's constructive. Okay, so now you move up, you're holding tight here. Now it might pull back in to the 10-day again, but this stock's acting well. If the market continues higher, this will probably continue higher, and whether you buy it at 36 or 38 or 39 is not really going to matter, and it's certainly not part of my objective with taking a position in a stock like this. I'm looking for something that's going to double, okay, or at least go up 50% and give me some upside. I'm not worried about 2 points here, 2 points there, and I notice a lot of people seem to be overly fixated on that. Something starts to move one way or the other a few cents, and they start to get all excited, or they start to get all upset, or these emotions come into play, and it's really silly. Ask yourself, what do I expect from this stock? What do I think I can get? If it isn't giving it to you, then there's no reason necessarily to stay with it. So those are our 4 positions right now in the portfolio simulator. So I want to go through some of the areas that have been acting a little bit better. Have been the stuff stocks, obviously, and we recently put out a pocket pivot, which is also a breakout. So according to Dr. K, this breakout occurs on nice volume, but it's also a pocket pivot, so it exceeds this and all these other down volume days over the last 10 days prior. And it's acting okay. So even pulling in here, this might be viable right here on this breakout, and you have a pretty ready stop. You could use a 10-day, you could use a 20-day at 70.45, or you could use a 50-day at 69.84, or the 65-day exponential, which is one of my favorites. And you'll notice that it actually does find support here. Volatile, a little more volatile stocks that are sloppy around the 50-day will tend to follow the 65. And you notice Rio is one of those. You see that? Now, why does that work? Well, I know a lot of people actually use the 65-day moving average, both simple and exponential. I know there's some people who like to email me that they believe the 62 or the 63-day is the one to use, but I think that's more of an ego thing. You can use a 65. It's close enough because it's not going to vary too much from a 65-day. But it's interesting that you do get the ego where people want to think they've come up with something new and exciting. But, you know, a lot of my friends have used the 65-day for a long time, and you know what? In some stocks, generally the ones that are sloppy around the 50-day, such as Rio, it tends to work as an area of support. Surprise. Because probably a lot of people use it. So I think in these markets, that's something to look at, and I would definitely advise, if you're a trader like I am, using that on your charts. So I think that looks pretty good. We look at Walter Industries, coal stock. It's doing a lot of what ACI is doing. If you notice the ACI pattern in there. I'm using candles, by the way. I hope you know how to look at candles. The open, the close. The range here is the intraday high and intraday low. If it's blue, it's up. If it's red, it's a down day from open to close. So here you have Walter Industries, a little bit sloppy around the 50-day, right? But notice, where does it seem to hold? The 65-day. So this could pull back a little more, but it looks like it's holding okay in here. So you look at here, this one acts a little better. So Walter Industries, or Walter Energy, I'm sorry, is probably viable off the 50-day right here, assuming the market holds, which it seems to be doing right now. And that looks okay. So the coals look okay. You know, some people ask me about PUDA. $12 stock. Again, I want to emphasize this idea that if you have a choice between two stocks and all things being equal, I go with the higher price stock. Of course, the common complaint there is I can't buy enough shares. Well, why do you need to buy enough shares? You only need to buy a certain percentage of the stock in your portfolio, whether that's 20% of a $10,000 portfolio or 20% of a $1 million portfolio. It's the same thing. So obviously O'Neill talks about that all the time. Get over shares and get into percentages. What percentage of your portfolio does it constitute? So got my trading desk yakking at me. So that's what I'm looking at there. So I actually like WLT is my favorite coal, and ACI looks pretty good. There are other ones as well, but I'm going to focus on those. So moving along, the other thing to look at are the solars. You know, some people like FSLR. It's an old leader. It's trying to break out of this pattern. Minus 23% earnings growth in the most recent quarter. I'm not really convinced, so I'm not going to play here. Yesterday we put SOLR, GT Solar, up on the pocket pivot review. We were pointing out the pocket pivot move yesterday. Today this thing is kind of flopping. Bank of America came out earlier this morning and downgraded the stock. Bank of America, well, I don't think too much of them, but that's what they're doing. The stock's holding in here. But again, this is a cheap stock. And so I would have some issues with that. Now, everybody likes to talk about this one, DQ. And it has great return on equity, huge estimates, you know, selling at 9 times forward estimates. But, you know, I learned a good lesson last week with CCME, which I'll get, China Media Express, which I'll get to in a second here to make my point. But the bottom line is that if you look at the sponsorship here, and I can pull out this screen from Bloomberg, let's go. And you're going to get to see how lame I am. Whoops. I don't know what's going on here. Lovely. In any case, if you look at DQ's sponsorship, there's only like 6 or 7 mutual funds in there. I would feel a little more comfortable with SOLR. Uh-oh. I'm not sure what happened here, but it looks like my keyboard is locked up. So we'll do it this way. All right, people, we're going to have to go into a different mode here. For some reason, I don't know what's going on with the Bloomberg machine. So what I'm going to do is switch to eSignal. Bingo. So as I was saying, with SOLR, let's get all this stuff out of here. You've got about 320 mutual funds that own the stock. So I think this looks a lot better in terms of sponsorship. But again, it's a cheap stock, so I'm not really convinced there. If you look at some of the other solars, you know, this is trying to form a cup with a handle. Let's make this a little bigger. You can see you're trying to form a cup with a handle. It's a daily chart. And it's not really holding in. You're getting some selling off the feet. Still not ready. Another one, LDK. Everybody likes to talk about this one. This may be forming a cup with a handle, and it's pulling back. Volume's not running about. It's running about average, I think, for the day, or maybe a little bit over, and it's pulling back into the 20 days. So maybe this one works. But again, these are all cheap Chinese stocks, and what we found out is you got to be careful with these because they can look great one day, and then they blow apart. And when you see something selling at 9 times estimates, and it's a $12, $13, $14, $15 stock with huge earnings estimates going forward and big ROE and all sorts of great numbers. You got to ask yourself, why is this thing selling at 9 times? I'd rather own something like Netflix, which everybody likes to complain is overvalued. If it is, it's getting even more overvalued. So solars are kind of iffy to me, and we don't really like that. If we're going to play energy, we'd rather do WLT, maybe ACI. Hal is another one in terms of the oils, and Hal's broken out from here. I talked about it a week ago. It's moved higher. I would look for a pullback into the 10-day moving average as a possible point to be buying the stock. Other stocks that have acted well in the oil patch, of course, Contra Resources is pulling back light here on very light volume today, so that looks kind of interesting. Let's make this a little bit less messy here for everybody. And so you can see it could pull back into the 10-day down into here, but this one looks okay. Moving along to the cloud stocks, of course, Acme Packet, a big viable gap up, I guess. Dr. K, is this a viable gap up?
It would be, yeah, and it's a leading stock as well. So it has all the, it ticks all the boxes.
So would you buy it here?
I would have actually for yesterday, the gap up 2 days ago on this kind of stock. It is a leading group. However, the F5 news makes it a little bit more difficult to just step in and buy this. So it's a challenging move to actually buy it on that gap up. And it's also, the gap up occurred out of a fairly erratic pattern because of what had happened to the cloud stocks.
Right.
So it's perfectly acceptable to not have bought it on that gap up day and to wait and see what it does from here. It might consolidate that gap up and then move higher, offering another pocket pivot, in which case I would probably step in.
On A packet?
Yes.
Yeah, okay. F5, now what's interesting here is if you look at this pattern here, and then it jams on earnings there, F5 did something very similar to that back in October of last year, and so you're kind of seeing the same sort of thing. It took a while to go anywhere, and you had a lot of shaking around. You may have the same situation now with A packet, but for the most part, the group, if you look at it, it's broken down, and at best, you know, if you think about CRM, for example, all it did is pull back in here on top of this prior base. It's forming a potential double bottom, so you're running into some resistance at the 50-day moving average here. You know what I'm going to throw on? I don't have a 65 on here, but I'm going to go ahead and do that. If anybody uses eSignal and you don't know how to do this, you might want to check it out. Now we have a 65-day up here, but you're running into the 50-day. This might be resistance, but this might be okay longer term. I still think the numbers for the cloud computing sector look very good. I saw estimates that by 2014 you're looking at somewhere around, I don't know, $14 billion, $12 billion versus $2 billion in sales in cloud computing. But what that does is it brings a lot of entrants into the space. And you notice the other day, Rax, along with another company, and Cisco announced that they'll be allowing or offering server space. And so this brings up things like Amazon and, of course, Akamai, which are doing similar things. So I think Akamai is a stock to keep an eye on as a potential short, believe it or not. And I actually am testing a short position in the stock today. I'm up a little bit on it on this little rally, but I'm basically using the 65-day up here at 49 roughly as an upside stop on this position. But I'm sort of testing this out because I want to see, is this market strong, is this weak? You know, we have some long positions, but that's the long side of the market here. I'm just checking this out, and you'll notice what it is. You have tries to break out once, twice, comes up a third time and fails. So to me, that's like 3 and out. And now you're underneath all the moving averages, starting to roll over. This one, looking at, I think, competition for their server farms from Amazon, from Cisco, and Rax, which has been acting very well. So I think those are really the areas you want to stay in. Is the stronger stocks. Cavium is another stock that I like. Here's another breakdown here, but this stock had a nice move. You have a breakdown in here, and looks very similar to A packet. They came out with earnings here, try to gap up. They're holding tight. I'm just watching these. A lot of these need to base. In the semiconductor space, we liked ARMH. We flagged the pocket pivot here as it was coming up off the 10-day moving average 4 days ago. It runs up and it holds very tight. And this stock is going bonkers. It was up 20% in just a matter of a couple of weeks. So, you know, the rule of holding it 8 weeks, I guess, holds for this one. But we don't really follow that rule, and we get a lot of questions about it. Dr. K, can you expound a little bit on your views of the 8-week rule for stocks that are up 20% in 2 to 3 weeks?
Yeah, sure. I mean, the rule works in enough cases. However, I prefer to use price volume action to determine my sell stops, and as well as being able to sit in a position for the long term. I found that the 10 and 50-day rules that I created work much better than this 8-week rule. I mean, 8 weeks is a bit arbitrary. Basically, the idea is if a stock is not really moving fast and you have a 20% or more gain in 8 weeks, then you should just take your profits, take the 20%. Now that does work in some cases. I have used that. In other words, a stock in my portfolio, it's not moving with the rest of the pack, and I've got my 20%, and I'll take it. But what I find is I don't actually formally use the rule. I don't even think about that rule. All I think is, what is my weakest stock in my portfolio? Okay, it happens to be this one. I've got a 25% gain. I've had the position for 9 weeks. I'm going to ditch it because there's this new stock coming out, breaking out, that looks a lot better. So I'm always force-feeding my money into the fastest horses in my portfolio.
Okay. So does that mean people should stick to the 8-week rule?
It's not a bad rule. It depends on your trading personality. It doesn't work for mine. In terms of my portfolio management style, I like to typically hold 8 to 16 positions in a strong market. Now, let's say, I mean, if we look at any of these other years where we had good market years, 2003, the 1990s, part of 2006, I would typically have on average between 13 and 16 positions. Now, it was a dynamic list. In other words, the stocks at the bottom of the list would usually get halved. I would halve the position, so I might start with 25% and halve to 12.5%, or I might blow it out altogether to make room for a new stock that was breaking out, that was emerging, that I felt would better the performance of my weakest stock or stocks in the portfolio. So in other words, I wanted to maintain a fully invested stance, so I would have to make room by selling out my weakest position to allow for the strong stock to enter my portfolio.
Okay. In any case, that one's acting pretty well. Another one that you've been asked about is Cirrus, and I covered this one last week. This one's going bonkers. I guess they beat earnings. You had a gap up here, which would have been viable if you had the guts to buy it if it was already up here. And it's pretty well extended, but it's acting pretty well. But you have to keep in mind also that this really is not too far out of the gate here, and so it may form another sort of buy point in here, and I would just watch for that. You know, it's been a cheap stock, formed a big kind of loose, ugly base, wasn't really very tight. It tightened up in here, pulled back, and took off. If you own it, this one looks fine to hold on to, and I would say based on the action so far, you know, you'd expect a pullback down a few, 5 to 10% would be normal, 11%, possibly a little more. Could take you back down into 22 from here, but so far so good. And that acts fine, so I don't really have any issues with that. Another stock I like.
Gap up, if you actually stay on the Cirrus for a second, the nice thing about a gap up is that it often resets the prior pattern. So if the prior pattern is faulty, in the case of Cirrus, it certainly was faulty, but that gap up that occurs on the right-hand side, I mean, in other words, the base has had enough chance to form, and that gap up that appeared right at the open is actually your buy point if you're nimble, if you're quick enough. And a good exercise is before the market open is to see which stocks are looking to be gapping up pre-market. You know, and isolate them based on their average daily dollar volume traded and their market capitalization, because obviously you want to be looking at institutional quality stocks, and of which this, of course, is one. So at that opening, that would have been a viable buy. If you hadn't bought it at the open, because of course it was easy to miss, you could still take a position somewhere during the trading day, because certainly the volume was quite massive.
Somewhere in here, right? Yeah, and really your downside is maybe about 10% down in here. Even if you bought at the peak, it looks like, and it never really pulled back very much. So that's acting pretty well. One that I discussed last week when we had our little webinar right here, as it was pulling back and it looked okay, Altera, and it held. You know, it comes back on top here. It's moving higher. Altera is a hardware play, and this actually is acting okay, but it's a little bit extended here. I'd look for any kind of pullback into the 10-day at about 38.50. Let me see if we have any questions on other semiconductors. I'm getting lots of advice on what's wrong with my Bloomberg. Yeah, and somebody says I had a pop-up, probably had a pop-up on my Explorer that's locking it up, and that's exactly what happened. I'll stick to the E-signal for now, though. We talked about F5. Somebody asked about that.
You can go to CCME. I wanted to mention one thing about CCME.
Okay.
Now, one of the sell rules when it comes to gap ups, you might all remember, is that if it breaks the low of that gap up low, you sell it. Now, I have a rule where I allow a stock a certain amount of porosity, in other words, a little flexibility, so that if what I've noticed is some of these stocks will undercut that low by 1 to 2% and then head higher if they are leading stocks. So you sometimes want to give the stock a little more room. In the case of CCME, I actually had a position in this stock. It went all the way to 24, then came straight back down. So my rule the next day was, if it breaks the low, I'm not going to give it any room, because look how far up it went. It's hugely volatile. I'm not going to give this thing any more room than I need to. So I put my sell stop right at 20.42, which was the low, 0.01 below the low of that gap up day. And sure enough, it was triggered. And then, of course, I had no idea this would happen, but it's always nice to obey your sell stops and see them working in action. And not hesitate. In other words, always adhere to your sell stops. That's probably one of the most important rules in investing.
Some of you may notice also that on the Follow the Stock Portfolio Simulator last week, we took a position at around 22.56, and I didn't really like the way it was acting as it started to reverse over, and we actually dumped it right away. So anybody who wasn't paying attention, we did actually get one email from somebody complaining about our recommendation on CCME, but we didn't make a recommendation. We simply pointed out that we were going to buy it in Portfolio Simulator, and then we pointed out when we sold the stock. So obviously, people need to pay attention if they're going to follow the Portfolio Simulator. And it's really not fair to start screaming at us if you were dumb enough to sit with this and hold it. I mean, where are your stops anyways? It's really ludicrous. But again, CCME is an example of a stock. It had about 40 mutual funds in it, or it does, and so it doesn't have huge sponsorship, and it also was trading at 5 times estimates or something, with this massive ROE and massive sales growth and earnings growth. But again, low PE stock with such great numbers. Why is a PE so low? You want to see a high PE stock, because in our view, a PE is not a measure of absolute value. A PE is a measure of how the market is valuing the earnings stream of that company. And so low PE is a warning sign, particularly when you have big upside growth in the stock.
Yeah, I want to actually point out with these Chinese stocks, now these lower capitalized, thinner names, and I don't mean the junk names, I mean names like CCME that are viable names. They're borderline viable. And my view is it is worth the risk. When I took a position in CCME, I did so knowing exactly where I'm getting out of the stock. And so, on the trade, I think I got hit on the position by 6% or something, which is perfectly, or 7%, might have been 6 to 8%, totally within my risk tolerance levels. And the thing about these stocks is, once in a while, you will hit one that might run 50% up on you. I mean, you will make a lot of money in a short amount of time. But for every one that you hit like that, you're going to hit a bunch of these kinds of stocks, CCMEs, that are not going to go anywhere, and you're going to lose, a few percent, maybe several percent. But to me, it's worth it, because there's enough viable, borderline viable Chinese names that will run up on you very quickly. And so, again, when you're strategizing your what to put in your portfolio, you should go into the trade knowing that. I mean, when I go into a stock like CCME, I know the odds of me hitting it out of the park on this are probably 1 in 5. And when I say hitting out of the park, this thing going maybe up into the 30s, and then taking profits. So knowing that, I'm comfortable trading this type of stock.
We might point out Rhino was a good example last year of a Chinese stock that issued some pocket pivots, and then it took off on a nice run. Of course, it has since died a miserable death, as you can see here, and it's now trading at 2.5. So yeah, there's a lot of risk with these Chinese stocks, and China may be an economic wonderkind, but there's still a lack of transparency. Just because I'm getting a lot of emails on this, you could add to your position on this breakout. Here's your pocket pivot that you had. We actually had this gap up here, but it didn't work out. One of the things about a gap up is if it doesn't clear resistance, a lot of times it can run into some problems and pull back. But it pulled back normally just above the 50-day here, and now you're breaking out again. And this is another stock, I believe, that the guy who likes to get up on TV or wherever he gets up in the media and yak about his short positions, like his short in Netflix, he's also short Lulu, which I think is another silly move. But those are people who are graduates of what I call the University of I am smarter than the market. They're going to tell the market what it should be doing rather than paying attention to what it's doing. So yeah, you could add to your position if you took it on the pocket pivot that we flagged, I believe on Tuesday. That was a good call on that one, Dr. K. I was a little skeptical of this one, I have to admit, but Dr. K.
What's nice about these gap ups is that on a gap up like Lulu, your risk is really low in buying, say, on January 12th, the gap up that didn't work, because if you had bought on that gap up and then sold using say 1% porosity, 1 to 2%, you're risking basically a 3 to 4% loss on the position. Now, if you then re-entered the stock on the 1st of February on that gap up, you're already in the money. I mean, you're already up net. You're already netting probably 2 or 3%, and this thing looks like it's going to go a whole lot higher, right, assuming the market follows in as well.
Yeah, so this one looks pretty good, and it's one of the better retailers out there. Amazon. I was on Fox Business a while ago. I liked the stock when it was up in here. The breakdown through here is not constructive, and you're somewhat wedging up back into the 65-day moving average. Notice how Amazon broke down, found support here, is trying to come back up here, and then gaps down on earnings. It may need to build a base. I think Amazon is still a stock that will find support. I don't think you're going to see it break down wholesale unless we get into a real serious bear market. In the meantime, I do think that it's going to need some time, and it's possible it could pull down more and undercut some of these lows as it builds a bigger base. This sort of wedging action down in here, you see the volume not picking up, actually declining as it's pumping up towards the 65-day moving average, exponential moving average here. That's probably problematic. I'm going to go through the big NASDAQ stocks real quick. Now, Apple recovering very quickly. Here's the day that the news on Steve Jobs came out, and then the next day is earnings, and it reverses. It comes right back down in here, more or less on top of this sort of ascending structure. Closes right above the 50-day here, and then is able to pull back out. You're not getting a lot of upside volume in here, but also Apple is not breaking down. And Apple's another one of those stocks, I think, selling at 17 times estimates for a big cap growth leader. That's I don't think you're going to see institutions running out. It's a big favorite of institutions, and it becomes a value play initially if it starts to come off here and starts selling at 10 to 15 times forward estimates. Apple is still a juggernaut. I know I told you guys last week, or those of you who were listening last week, I have bought 3 iPads just to test them out. We're looking at perhaps developing apps for virtuous selfish investing on the iPad and possibly on the Android-based tablet computers or PCs. In any case, Apple's acting okay. There's nothing really wrong. I wouldn't buy it up here. But if I held it, I would still be letting it do its thing. It seems to be okay, and you could use a tight stop in here on this rising trend line from here to here if you wanted to, if you were nervous about it. But it looks like it's holding right now, and I think for now that's probably good for the market. Of course, Baidu is another big stock, and we see what it's doing today. A little pullback acts fine. Google coming in here, holding above its 50-day, broke down on earnings, but you're not seeing a lot of selling now. You've had the big break, you found support off the 50-day. Notice how it dips below the 50-day and finds support right at the 65-day moving average here, and is able to hold up. So some people say Google will be a juggernaut in the cloud computing space as we go forward, and maybe that's true. I'm willing to let the stock build do a little base building here rather. And take a little time to keep an eye on it. But I would say that for the most part, it's telling you that there are constructive things going on in the market, even though it may feel a little bit slushy at times. And you can see that with things like Netflix moving today, Lulu's moving today, a few other stocks, CMI's acting well today. So those look fine. Oracle's another big NASDAQ stock, the granddaddy of cloud computing plays. You have good upside volume. This is actually a little pocket pivot maneuver. You can see that. We didn't flag it, but it is the highest upside volume, higher than any downside volume in the last 10 days, prior 10 days rather. You're pulling back slightly into the 10-day moving average. This could be viable right here because you're really close to this breakout from this very tight pattern. Some of you may notice these little black triangles. These show up on my e-signal charts, and we have an EFS file for eSignal that will do this, and we may put it up on the website for download. Dr. K, is it possible to do that? Can we look into that?
Yeah, let's take a look.
Okay, so we may put that file up on the website later to download for eSignal, but it's an EFS file that tells us when the stock is up 12 out of 15 days in a row or better. And this is an old rule from our old shop. When you have that occur, stock does that 12 out of 15 days up in a row or better, and then it pulls back as a little consolidation. When it breaks out here, you can buy the stock pretty aggressively coming out, and it's holding. You know, you can see the volatility in the patterns, and of course that's always a cautionary sort of sign. But I think it's just a function of a weird QE market, and you have to be able to sift through some of this volatility if you're going to make money. And so that's why I advocate on the portfolio simulator, taking a very measured, a very deliberate approach and not really getting carried away, just kind of doing it really by the book. And this may be one of those periods where doing it steadily by the book is the way to go. Some of the other big NASDAQ stocks, let's see here. Priceline, holding very tight. What I notice here is you're running a base here. You broke out, now you have another base on top of it. Stock seems to act okay. They're coming out with earnings in a few days. That may come out of here. I'd watch possibly for a viable gap up, you know, but there's potential for some of these being later stage bases. You know, Priceline's been going for quite a while. If you go all the way back to 09, it came out, broke out here, set up in a big ugly base here. I tend to see this as a reset because you undercut the prior lows, and then you have a viable gap up here on earnings, and then again it breaks out, and so you're really, this is really, to me, this is a first stage base because you undercut all these lows, you kind of clear the decks and reset. So first stage, you know, these are all little tiny pocket pivot type setups on the way up, and now here's really a second stage base, and what's interesting here is it seems to be setting up as a base-on-base formation. So we've watched this one on earnings. It may surprise again and end up going higher. But that's definitely one of the big NASDAQ stocks here. Another big one that seems to be, oops, I've got to give it 2 M's, is Research in Motion. Somebody upgraded it. I don't know. I'm kind of neither here nor there on RIM. You know, I've gone long the stock and I've shorted the stock on these jags up and down. Using my short-term trading techniques for shorts on, but it's a little bit of a dicey play both ways. It tends to move on news. I would prefer to go with some of the leading stocks, but it is a big NASDAQ stock acting well today, and it has been acting well, so we tend to think that that's a good sign for the market. Let's move to medical stocks. Now, United Therapeutics was a stock that we bought initially in the portfolio simulator right around here, like around 59. And it ran up, and then we added in here, and then we recently sold it up here, mainly because it was up about 15% for us, and it took a long time to get there. So we decided to take some profits, especially given the way the market was acting. Of course, now it's finally testing the 50-day moving average here. It's probably still okay. Investors Business Daily had a nice big article on the company in today's paper. I would take a look at that if you haven't already, just to understand what the company does. I like the story, I like the earnings, I like the return on equity, profitability, the sales, all of that is very nice, and this pullback to me seems like a normal pullback, and it could present a buy opportunity, because if you take this as your first breakout, let's go in here. Here's this big ugly base, and you see this is what I call a lean-to cup with handle, because it's mostly the left side of the hand or the cup here is kind of leaning over, and then you jump up here and you consolidate for a little while, and now you gap out, and here you break out again. So really you could consider this as being you know, your breakout level right here. Okay, so if you have that and this is your first breakout, then I don't want that. Get that away from me. Here we go. This is your first pullback to the 50-day moving average. So this could be a buy spot or an add spot if you did hold on to it. But it's a slow stock, but it acts okay in this environment, and that's saying a lot, I think, when some stocks are not so consistent. Another one of my favorites is Jazz, Jazz Pharmaceuticals. We talked about this last week. You had a pocket pivot. Let's make this a little bigger so you can see it. Yeah, this pocket pivot here. It moves back above the 10-day moving average. There was news that there was a adverse event report where somebody who was using their drug, one of their drugs, died, and when that happens, the FDA has to file that report. It just means a person was using the drug and they died. It would kind of be like, you know, I've been taking aspirin and I died. Was the aspirin the cause of it? Well, it could be, but we're not sure. So in this case, they don't tell you the cause of the person's death, or that necessarily it was due to taking one of Jazz's drugs. It just tells you that it occurred, and of course they sell off the stock, but it tells you that money comes in here and supports the stock. Jazz is a very interesting situation because it was a cheap gap up here. In some of my other commentary elsewhere on the web, I did talk about this when it happened. You had another pocket pivot here on the way up, and now it's setting up in the base. A lot of times stocks start out really cheaply, and they grow up. And I don't know, maybe Jazz is one of those stocks that's going to grow up, but this is the first base it comes out of. It has a nice move, but maybe this is its first base. I would say if I'm interested in buying the stock, if you already own it from down here, you can certainly sit with it and use maybe the 50-day at 2010 as your stop. But I would look for this stock to form a base because it looks like it wants to. And I got to tell you also that these stocks like Jazz or UTHR, you won't find them generally if you're sticking to the classic O'Neill 80 EPS strength and 80 relative strength as your cutoff. I actually use the composite rating, which is a much more comprehensive rating, and I just look at stocks that are 85 composite rating or higher. And if I want to look at outlier names, in other words, stocks that are starting to emerge and are up and coming, like Jazz was back here, I'll drop that to 75. And I just scan these lists to see what looks good and what might be emerging. But for the most part, the composite rating is what I'm looking for. And a lot of times you will find a stock with a 72 relative strength, say, and an 85 EPS rating, but it'll have a 95 composite, and I give that much more weight. So we've kind of been babbling for a while. We have some questions. Well, some questions, just putting it mildly. I do wish that they gave me some more room so I could read these a little bit easier. Somebody asked about IAG. This is a good segue. IAG, I don't care for IAG, to tell you the truth. You know, gold stocks, I am gold. Okay, I like that, I am gold. But here's like a long cup with handle, like a ladle, you know, soup ladle with handle type situation. It's breaking out. I don't like to buy gold stocks when they're breaking out. I like to buy gold stocks when nobody wants them. But the bottom line is gold stocks have not been really even performers. They've been very erratic. So I don't really need to play there. What I would be watching is gold. Again, we talked about this last week, and gold is probably setting up in a consolidation. I think the downside here is to the 200-day at about 125 on the GLD, but I think gold needs some time to build a consolidation. That's very much its nature to run up and then have to go through a consolidation. So you run up again here, you're starting to break down, and now you need to consolidate. Same thing with silver. So if I were going to play precious metals, I would rather do it using the SLV and the GLD and not necessarily gold stocks, because they're nightmarish. You know, they look great. This is one that I was buying here, and of course it immediately breaks down and turns around and goes to new highs so that you can tear out some of your hair. You know, runs up again, breaks down sharply, and now these things are in no man's land. So to me, I don't really want to be playing golds currently. I think if you're into cotton, this is the soft goods ETF for commodities, and there's been a talk of a run on cotton lately as manufacturers of clothing and whatnot have been stockpiling cotton. Now in the short term, of course, that creates upside pressure on the commodities, and you've been seeing that in this Dow Jones UBS Softs sub-index, and that's related as well to the whole concept of increased demand and dropping dollar as well. So I don't know if this is something I'd play, but it is interesting to note. It's been making the news lately, and people are asking about that. Somebody asked, we talked about F5 already, so we have that question. Somebody asked about TJX. I'm just going to blitz through these real quick. Nice stock. Looks okay. I'm not really that interested. The breakout looks kind of interesting. It's up 12 out of 15 days here, and you do jam out of here. Maybe it's Bible. I don't really know what the story is going on with TJX, but earnings in the last quarter were up 14%, so that really doesn't meet my parameters. So, and I noticed that you have Target is another retailer that's getting been clocked. Ross started. In fact, that if you look at Target,
to look at the past price history of these stocks, TJX is a great example. If you pull up a weekly on it and you go back a number of years, say to 2004, you'll see that it really never ever moves quickly. I mean, if you're going to get into the stock, be ready for a very slow stock, and that's in the best case scenario. I mean, even in 2009 when stocks were rocketing through the roof, I mean, this one, you know, it doubled that, or it more than doubled, but that's pretty sad in a year like 2009 where most stocks were up, you know, 200% or more off the lows of March. So this is a slow mover, and you know the relative strength reflects that it's 56. So it's not a stock we would ever really recommend for the list, just simply because it's a bit of a dog.
It has been, that's true. Also, you notice we were taking a look at Target here, and Target almost looks like a short here to me. You have this massive, you could call this a breakdown. You gap down, you see how you find resistance here at the 65-day exponential. Now you've broken down below the 200-day, and you're kind of wedging back up into it. Volume is lighter than average today so far. This actually could be looked at as a short. Hey, Bill, are you there? I think Billy went to sleep.
Yep, I'm here.
There,
sorry, had you on mute.
Borrow me 50,000 TGP, please. Let's see. Getting back to, where was I? Okay. So see how I come up with ideas? I do webinars. But Ross Stores, here's another one. Yeah, that's breaking out. That looks okay. And it's kind of related to TJX, which I think is TJ Maxx. These are cheap places. One time I gave my wife $3,000 cash and told her to go to Nordstrom's and buy whatever outfit she wanted. And she came back and she said, I can't buy anything there. It's too expensive. So she went off to Ross Stores and spent about $350 and came back happy as a clam. Now that's a wife who's a keeper, let me tell you. She doesn't spend your money. And that's probably part of the reason that we have what we've been able to build over time. In any case, Ross Stores, actually, you could consider that a viable gap. But what do you think here, Dr. K?
Yeah, it's a better stock than TJX. It is a viable gap up. It's a clean pattern. If you look at the weekly, it's not a fast stock, but when it does get going, you know, you can make a fair bit. It's got decent time value, I guess, is the bottom line here. And the fundamentals look pretty solid to me. The composite rating's 89, so
yeah,
it's viable.
Yeah, you had earnings up 21% the most recent quarter with sales of 7%. It's pretty minimal, and but it is breaking out. But to me, this doesn't really have the kind of fundamentals that I'd be looking for. But it definitely has nice technical action.
Yeah, it's a passable name basically. It just barely makes the cutoff, shall we say?
Right. Somebody asked about Cisco. I don't know. No real volume coming up. I wouldn't waste my time on this thing. Dr. K, this is a good question for you, Dr. K. Could you talk about staging buys into the MDM ETFs? Wait for upward gains or stage in now while flat? So in other words, if you're on a buy signal, how do you come into this?
Right. Now I've received that, and I think I put up an FAQ just on that matter. Essentially, it depends on your risk profile. Some people prefer to allocate a fixed percentage on a buy or a sell signal and just follow the model to a T, because you can go back into the records. You can look at how the model did against the NASDAQ Composite and the 3X ETF TYH. Now, following the model to a T is easier said than done, and I speak from experience. For me to say allocate a certain percentage of my portfolio automatically on a buy or sell signal is not the easiest thing in the world, and so I don't expect it to be necessarily easy for anyone else, or you know, maybe it is, but not for me. I tend to like to allocate a certain percentage to the ETF and then the balance to stocks. So I like to maintain flexibility in my portfolio. I think it's perfectly fine to say allocate half your position on a buy signal, and then as you have, say, a certain percentage gain in that ETF, to allocate the other half. In other words, you're in a way dollar cost averaging. You're not dollar cost averaging, but you are making sure you have some kind of cushion in the position before you allocate further funds into that same position. Perfectly viable, and psychologically also I think would work for a lot of investors. But keep in mind, if you do it that way, you're not going to realize the same returns, the same performance returns as the model has been able to generate. But that's okay, because you are then moderating your risk levels. Okay, I'm going to go through some more names. We're getting some questions. We'll go over by a little bit. It's 9 o'clock right now. We were
expecting to stop, but because we've had some glitches and getting off to a slow start there, we'll go for another 5 or 10 minutes here to cover some names. One that comes up is Fossil, and Fossil's been one I think we identified a pocket pivot in this one long ago. I think back when we were first starting the website, in fact, and it's had a few of them, but it's breaking out. The volume looks okay. I think they're coming out with earnings pretty soon, aren't they, Dr. K? Yeah, in fact,
yeah,
they're
like,
expecting 16th.
Yeah, they're reporting on the 16th, I think.
Yeah, so it is breaking out. Volume today is not really heavy, so I'd be a little bit cautious here. That said, it could just blow to the upside on earnings. That's a possibility. But I would say with the volume not being real heavy here, I'd be a little more cautious here. I don't think this is necessarily a primary name that you have to be in here. Frankly, I'm looking for newer types of situations, more powerful breakouts, and that's why if you look at the Follow the Stock Portfolio Simulator, I think those are 4 great names to be looking at in this market, and they seem to be acting pretty well in spite of whatever the market seems to be doing, and so that's where I'm going to focus in the Portfolio Simulator. Let's see, another stock, Dow Basel, which is a name that I've liked for a while. It just continues higher, and this is a big stuff stock, all kinds of stuff related to chemicals and things like that, and it just continues higher. There's really nothing wrong with it here. You're holding the 10-day. You actually see here, well, there's a violation of the 10-day. It looks to me like it tends to hold the 20-day moving average better. So you might want to use that as your guide for the stock. Although a pullback to the 50-day down at 33.58 or a little higher if it continues to rise looks fine to me. Now notice we get these ants here, 12 out of 15 days up. One of the things about this, though, I would point out is that when this occurs later on in a run, it might have less of a probability of indicating strength. It just may tell you that everybody's rushing into the stock. Here it's probably a little better, but I like to see them occur right after breakouts. So it's acting fine right now. There's really nothing to do. Somebody asked about ASYS. Not really a stock we've been following. It's a semiconductor. I tend to like, the CRUS, the Cirrus looks good, the Altera, ARMH. I tend to like those better. So that's the one I would not go for. Somebody asked about Adtran. Adtran continues higher. This stock, you actually had a viable gap up here. One of the services we don't have right now, which we should look at adding, Dr. K, is viable gap up alerts, because we see these, but we don't really have a mechanism for telling you about them when we see them. And we do see them. We actually have a pre-market screen that will tell us all the gap ups that are going to occur before the open that are showing on the bids being up from the prior close. So this one would show up here. Adtran, I think, is adding, they've got a government contract for internet services, and they've been supported by the government. And so that's always something that's been made that's made me a little bit leery of the stock. However, it's continued to act very well. This is a viable gap. If it's continuing higher today, we're not halfway through the day, so it looks like you might get some sort of a pocket pivot coming off the 10-day. But that stock, surprisingly, at least to me, it has acted pretty well. CMG is, yesterday we pointed out the pocket pivot. And then everybody, well, not everybody, we get a few emails, is this a late-stage base? Isn't this a late-stage? Well, maybe it is, maybe it isn't. That's another thing that I don't get into, is the third-stage base that's the end of it. That's not true. You see a lot of leading stocks will have 4 or 5, sometimes 6 or 7 bases before they finally top. So I don't really know where that rule came from. But statistically, Dr. K, have you done any studies relating to base stages and when you reach an ultimately high number of late-stage bases that tells you you're definitely running into trouble?
Yeah, actually, I was going to write a little paper on this phenomenon. Statistically speaking, when it comes to markets and trends, they have a finite lifetime, of course. And that finite lifetime in good bull markets corresponds often to a winning stock that will have formed maybe 4 stages, 4 base stages. So it's a bit coincidental. I mean, it makes sense. If the average rally goes for about 8 months or 10 months, then your average winning stock may form a number of stages during that period. Actually, I need to look at the actual months because I think it's actually longer than that. But that's what ends up happening is you get a lot of these stocks that will coincidentally top after their fourth base stage. And it's not because it was in the fourth stage. It's just because the market has a tendency of topping after that's run a certain amount of time. So I think a lot of people, that observation is being confused. In other words, the cause and effect is being confused there. And really, it comes back to following the price volume action of the stock. It's a winning stock. There are winning stocks that have actually gone on for 5 or 6 stages. And so to say that you're not going to buy a full position just because it's breaking out of the 5th stage base might end up costing you a lot of money left on the table. In fact, there's a couple winning stocks in 2003 that did just that, that just kept forming stages. And in fact, at the last stage, it doubled in about, I think, a month. And that was its climax top. So to not participate in that would have been a tragedy, especially on a time value basis.
Right. And I would say some people are looking at this as a 3rd stage base because they're seeing this area here as one base, the first base. This is a 2nd base, and here's a 3rd one. I would tend to take issue with that, and I think that essentially what you're looking at here is this formation here. You broke down, you undercut the lows in here, you got into this consolidation pretty heavily here. Now this also occurred between the May through August time frame in here. And as you recall, we had a very sharp market correction that occurred. And so in a lot of ways, you could say that CMG's pattern, this is really your 1st stage base. But again, as Dr. K said, getting bogged down in these black and white rules, like, oh, 3rd stage base, top it. Does that mean you short it then on that basis? No, of course not. But it's silly, I think, to try and establish or try and operate by these black and white rules. And I also think it's silly to teach people these sorts of rules when they really don't statistically pan out. And in fact, it is not a primary rule. It's something that you would have to use in conjunction excuse me, with the price volume action. So something doesn't become a late stage base until it finally does break down. So in this case, CMG coming up hard along the right side here today. And so that yesterday's pocket pivot was valid. You had another one here, but you'll notice it was a little bit lighter volume. It was a pocket pivot, I think this one here, coming up through the 10-day. Okay, it was this day right here, but that didn't come up through the 50-day. And pocket pivots that occur up through the 10-day but below the 50-day tend to have less probability of working, and what you really want to see is the thing coming up to the 50-day. Well, we saw that yesterday, and here you come. You're coming up the side. They come out with earnings, I believe, any day now. Let me check this real quick. On
is this the 11th on Wanda? February 11th?
February 11th is what it shows there. Same thing on Bloomberg. So, this is acting well. If you bought it yesterday, you're happy today. And we wouldn't get bogged down with this whole concept of late-stage bases. In our view, there's a lot of things in the O'Neill methodology that confuse people, and they're presented as hard and fast rules. Our task since leaving O'Neill has been to clarify, at least for our own trading, and refine upon a lot of the concepts that we use by using hard statistical work. And there's nobody who does this better, in my view, than Dr. K. So I should point out, though, that when his market direction model works really well, such as it did in 2009 into 2010, it's our model. But Dr. K, when it works like it has the past couple, 3 weeks, it's your model. Okay, are you okay with that?
Oh, that sounds fair.
But again, it is what it is, and it's going to give you false signals. I would also look at it. You see, when I look at a trade, when a trade goes bad for me, or if the market direction model is whipping you around with all kinds of false signals, we're simply giving the objective signals that the model gives. We're not trying to tweak it one way or another, or create a conspiracy where we're trying to fool everybody. It is what it is. But you have to also consider that when you have a failed trade, or a system or approach to the market that isn't working, or is giving you a lot of false signals, well, instead of getting upset about it, what you can say is back off a little bit and look at it in terms of providing you real-time feedback, informational feedback that's telling you something about the market's general nature right now. And so we know we're in this whippy kind of QE, quantitative easing 2, version 2 market. And so we know that, and the markets, the model is telling us this. Okay, so that's what I take away from the model. I don't get upset about the fact that maybe I bought the SQQQ on a sell signal and I lost 2 or 3% because I got blown out of it, or I went long again, the TQQQ, and got stopped. It's telling you something, okay? So you take that information and you implement that into your methodology in real time. And so I'm going to get back to what I started this presentation with, and that is my approach, which you can all see on the Follow the Stock Portfolio Simulator, and it's taking a very measured approach in what I consider to be big stock leaders in the market. These are the stocks: Netflix, Baidu. I like CMI. It's acting okay today, but you notice it runs into a little bit of resistance here. So this one to me is a little bit in flux. I was hoping it would come out, but we'll see what happens. But we're going to stay with the initial 12.5% position for now. And we like FTNT as well, and it's sort of probably a little too high. I probably need some time, but I'm going to take a position here and hang out. And I think this is the approach that you need to take. The portfolio simulator is under 50% invested, okay, and that's based on what the market is telling me, what the market direction model is telling me with the whipsaw signals, and that's how I sort of tailor my approach. If we're getting these signals in the market direction model that go, you get a buy signal and boom, the market's running, then that's going to tell me to be more aggressive. And I think you can kind of gauge or temper your approach based on what the market direction model is telling you. And instead of coming to us with the idea that, oh, you're going to use our market direction model. No, wait a minute, I'm sorry. It has a lot of false signals lately. So it's Dr. K's market direction model. You're going to use his model, and you're going to make instant money. Boom, boom, boom. Oh, yeah, and unless you do, there's something wrong, and we're terrible people. That's a ridiculous approach. It's utterly ridiculous. The way you should be using the model, not only to generate buy and sell signals if you want to play ETFs, but you should also be using the model as an informational feedback source. It's telling you something about the market, people. And so you need to take account of that, because I think the model is sound over time. I've seen how it tests out, and I've seen how it works in real time. And it has periods where it runs into some trouble, but that's normal. But I think it is telling you that you want to take a very measured, a very methodical, and a very slow approach. And so that is the approach you will see us use here in the portfolio simulator on the Follow the Stock section of the website. It seems to me that with the number of questions that we have, I could be here another hour, but
why don't we take those questions for the next webinar?
We'll take note of these. Yeah. Oh, I'm going to do one last comment. And we did talk about LVS last week. Okay. Now remember, we alerted you all to these pocket pivots. You had one here, right here, this day. Upside volume is higher than any downside volume over the prior 10 days. 1, 2, 3, 4, 5. 1, 2, 3, 4. That's 10 here. So 12. There's 12 days till you get to here. So this is your pocket pivot coming up through the 50-day. And it follows up with another pocket pivot type move off the 50-day, and then it sort of backs down. Now, when we put these out, and we put out a pocket pivot report alert, generally you have to use either the 50-day. If it's coming up to the 50-day on the pocket pivot, then that's usually our guideline for selling the stock. So an example here, and this is a good one, is you run up. Now look, you close below the 50-day here, and then here you go below the low of that first close below the 50-day. You're out of it. You're out of that position. Okay, you lose a couple of points. Whoop-de-doo, 5%, big deal. It comes down, and notice, because LVS is sloppy around the 50-day, it tends to find support at the 65-day exponential moving average. Okay, now what happens here is you come up out here, and I was watching this come out yesterday and a couple days ago, where you're getting this volume, but the thing is, you have this big downside volume spike here, and I know it's right here, so I don't know, you could say it's support, but it's still a big downside spike on a gap down here. So, to me, I want to see that thing come out and come back above the 50-day with a pocket pivot volume signature. Okay, you didn't get that, so it was telling you it was suspect. Earnings came out last night, and the stock's getting knocked back down. It's holding okay, but I don't think I want to be in the stock right now, and I didn't want to buy it coming up because you didn't get a pocket pivot buy point in here. Okay, the other cousin stock to LVS right now that we like and we're watching is WIN, which is forming this cup, and this is a high handle. One time when I first started at O'Neill, high handles were faulty cups with handles, but then some of them started to work, so we had to come up with the cup with high handle. And all of this points back to something Dr. K talks about all the time, which is that focusing on precise shapes of bases is really kind of silly, because it's really the price volume action within the base that you need to learn to understand. And pocket pivots are one component that help us to learn, or that help us learn how to understand what's going on inside of a base, rather than focusing on, you know, the perfectness of the pattern. I mean, in some ways, you could say that this cup with handle was just so perfect, and look what happened, you know. So if you're overly focused on the shape, then I think you're asking for trouble. You know, there was another one here.
In context with the general market, what the general market's doing.
Right. The shape within in the context of the general market. Look at Cree. Here's a big cup, beautiful cup with handle. You know, looked like it was gonna come up, but you notice it was actually coming up here. This is your uptrend. It was sufficient enough for a base to form, but you know, it looks nice, but it doesn't work, and it breaks down. And so the shape is not key. When I was at O'Neill, we actually hired a couple of PhDs to develop a base recognition program. And the program actually worked pretty well, but what it showed to me is that just because something forms a cup with handle doesn't mean it has a high probability of going higher. In fact, most cups with handles fail if that's the only thing you're looking at. Most flat bases will fail if that's the only thing you're looking at. However, you have to combine it with the context of the general market. You have to combine it with the fundamentals, the concept behind the company. What is it they're doing? You know, are they a major player in the economy, or with what's going on in the economy? Those are the sorts of things you need to focus on, and then learn to interpret the price volume action within the base in the context of the general market. And those are things that pocket pivot tools, the pocket pivot tool rather, and viable gap up tools allow you to do. And I think that's something to focus on. Last stock before I shut it down is Deckers. And Deckers just forming a base. It's climbed back above its 50-day. Nice support. Notice how it's sloppy here at the 50-day, but where does it find support? At the 65-day exponential moving average. Gosh, I think I've made a new discovery. I think I'm going to call it the 66-day. I'm going to use that, and then it'll be my own special invention. But like I said, I know a lot of people use a 65-day, and I find that in this environment it tends to work pretty well. It's also something I use on the short side. But I'm going to give you my short targets for the day just in case you're looking for that. ACAM, your stop is a 65-day exponential moving average at 49.15. I do have a small position in that I'm testing out. And I think Target is another stock. Using the 200-day as your stop could be a potential short if the market gets into trouble. Okay. Otherwise, shorting isn't going to be your strong suit here. And I think you want to be taking a methodical approach on the long side primarily. But I have to admit, I will mess around with some of these and take positions on the short side. And I actually have found that in some cases I can go both ways at the same time, and it'll work. So, and also I use these as a way of getting some feedback from the market. Again, if I take a trade and it goes wrong, I don't get upset about it. I take my loss per my trading methodology and per my stops. And I use the information to help me get on the right side of the market or get on a winning trade. Okay, so that's about it. Dr. K, do you have anything to add before we close up here?
I think let's take those questions we didn't answer and answer them for the next webinar we give.
Okay, everybody who's here today, thanks for showing up. Watch your email box, because we may do one over the weekend where we cover all of the questions that we got. We do get a lot of questions here. We do max out in terms of attendees. We're going to have to find a way perhaps to have up to 1,000 or 2,000, I guess. In any case, that's it for now. Thanks for watching, and we'll catch you guys next time. Okay, good luck today. Bye-bye.
Take care. Bye-bye.